our presentation, which is an overview of the American Rescue Plan Act and the impacts that it may have on your organization. Our speakers today are myself, my partner Kyle Neild, and Elizabeth LaCourte, who is a manager with the firm. The three of us and about 6 other people are part of our COVID consulting team. And we have spent the last 13 months now staying on top of all things COVID related to your business, individual opportunities for relief, state and local opportunities for relief. So our COVID consulting experts today will provide insights into the latest round of legislation designed to benefit small business, sustainability, employee retention, and other stimulus type provisions. Our thought leaders will walk you through the recent COVID-19 relief bill as the American Rescue Plan Act, which provides additional relief funding for business tax breaks for individuals and businesses, updates to certain payroll provisions, and changes to pension plans and employee benefit plans. This webinar will highlight what you need to do to optimize your benefits to help you continue to navigate the economic uncertainty that continues well into 2021. So we're offering CPE today, and to earn CPE, each attendee must log in individually to your session. I'm sure you got your own invite. That's how you got here. Successfully complete at least 3 of the 5 polling questions. Respond to polling questions within the allotted 60 to 90 seconds. You will not earn CPE credit if you log in using somebody else's link or just joining by conference call or phone, fail to complete the polling questions, or fail to remain logged on to the session for a minimum of 50 minutes, because that's what qualifies as an hour of CPE. Viewing a recording of this session. So CPE is only awarded for live sessions. Are we recording this session, Ashley?
Yes, we are.
Okay, good, because I've had that question. And upon completion of the program, you'll receive an event evaluation that you need to complete and send back to Ashley via email, and then you will receive your CPE certificate within 2 weeks from the date of the seminar. So let's dive right in. Our agenda, we're going to talk about ARPA, the coronavirus provisions for individuals, businesses, payroll, and the changes to the employee retention credit. Talk a little bit about how we can help, but we're really going to try to stay mindful to our timeline today, because we want to be able to get to questions, a Q&A session, hopefully around 1:45. We did receive a lot of questions ahead of time, so we have gone through those questions and tried to make sure that the answers to your pre-submitted questions are embedded in the information that we're going to cover. So from an overview perspective, the American Rescue Plan Act was a $1.9 trillion relief act signed into law March 11th in 2021. And it extends and expands provisions of the prior acts, including the Coronavirus Aid and Relief and Economic Security Act. I think we all by now know it as the CARES Act, and the Consolidated Appropriations Act, which came out in December. It also expands on the FFCRA, which was a precursor to the CARES Act. Well, it contains individual provisions, payroll provisions, business tax, and pension provisions. Actually, as I think about it, we removed the pension provisions because we really wanted, we didn't think that it would apply to most of the people that we saw that were signed up for today. So we pulled those out in the interest of time and getting to the Q&A on what we think are the frequently asked questions. So let's talk about the FFCRA. So the original act intent was to allow funding for paid time off and emergency sick leave through credits against the your employer's share of the Social Security and Medicare tax. So it required certain employers to provide paid sick leave and expanded family and medical leave for specific reasons. The requirements were initially through December 31st, 2020. Paid sick leave was for a period of up to 80 hours at an employee's regular pay rate. And then if they were eligible for family leave, they could take 2 weeks or up to 80 hours of paid sick leave at 2/3 of their pay rate if they needed to care for a sick child. So if they weren't sick themselves, they could use the first 80 hours at 2/3 of their regular pay rate. And then the original FFCRA provided for 10 additional weeks of paid expanded family leave. And it applies to private companies and nonprofits with less than 500 employees. So businesses that have fewer than 50 employees were exempt from certain requirements. And if they could prove that, it would have been a hardship to their business to provide the pay, even with getting access to the credits and have a position, to support that hardship exception, then they did not need to comply with the act. So changes from ARPA to the FFCRA. So it applies effective with calendar quarters beginning after March 31, 21. The Consolidated Appropriations Act extended the December 31st, 20 provisions through March 31st, and then ARPA picks up where CAA left off. It extends the paid sick and family leave credits from March 31 through September 30, 21. And it also provides that paid sick and family leave credits can be increased by the employer share and of Medicare, of Social Security tax, and the employer share of Medicare tax on qualified leave wages. Previously, it was the employer share of Medicare tax only. It also permits the Treasury Secretary to waive failure to deposit penalties on the employment taxes if you didn't deposit your taxes because you were anticipating a credit against your 941 payroll submissions. It also allows for credits for paid sick and family leave to be structured as a refundable payroll tax credit against the Medicare tax portion only, starting after March 31, 21. There was an IRS fact sheet that came out, fact sheet 2021-09. That's available as a reference tool, and it includes information about employers eligible for the tax credits, how these employers can claim the credit for leave paid to employees who take leave to receive or recover from the COVID-19 vaccination. So this was a change that came about after ARPA, and it was a clarification. So if your employee, and this happened here, some people are great when they receive the vaccines and they have no symptoms whatsoever, and other people are down and out for a couple of days. So this sick leave can actually cover time for your employees to get their vaccinations and then time to recover from the vaccine. ARPA also increases the amount of wages that you can claim the paid family leave credit per year from $10,000 to $12,000 per employee. And it expands your family leave credit to allow employers to claim credit for leave provided for reasons included under the previous employer mandate for paid sick time. So if you recall, there were specific reasons where if the employee were sick or they had to quarantine or isolate, you could claim a credit for paying them sick time to take off for those reasons. And then there were a separate set of reasons if you were caring for somebody in your family or a child that was off from school. So they basically allowed all of these reasons to be incorporated together and to support your payment of paid sick or family leave. So self-employed people, the number of days, they actually could take advantage of the credit as well. So a self-employed person can claim credit for up to 50 days at 67% of their average daily self-employment income, up to $200 a day. Originally, it was $10,000 in total. And these credits actually count against the amount that you owe in your federal self-employment tax for the 2020 year. So ARPA now extends this to 60 days and a maximum of $12,000. So I thought it was easier to just take a look at an example. And I'm having a lot of fun with my technical skills today. I should say technology skills. So let's see if I can get this to come up. There we go. Can we see that? Excellent. So I put together just a very brief example of 3 employees, one employee that has a daily salary of $400, the second $600, and the third $240. Their daily costs of healthcare and then also the Medicare, the employer's share of Medicare tax on the salary. So employee number 1 has a total cost of a daily cost of $505.80. Employee 2, $708.70, and employee 3, $318.48. So when you're calculating the sick pay wages available for credit, it's capped at $511 per day. So this cap only applies to the salary portion. It doesn't apply to the healthcare or Medicare costs. So employee number 1, they're eligible for the full amount per day. Employee number 2 is capped at $511. Employee number 3 is capped at the $240 because they're under the $511. With regard to family leave, so let's say this, and in my example here, this employee actually they need to have the full 10 days of sick pay. So there's sick pay wages of $4,000. Family leave is capped at 2/3 of their regular pay with a maximum of $200 per day. So they took the full 10 weeks or 50 days, and their family leave wages eligible for credit are $10,000. Employee number 2, in my example, they took 8 days of time and they didn't have any family leave that they needed to take. So, they were sick and they came back to work after 8 days. Employee number 3 took 5 days and they took 10 weeks of the paid family leave. Now, in also looking at the total costs, so the sick pay for all of these employees combined is $9,288. Family leave is $18,000. And just keep in mind these healthcare costs and Medicare costs, because these are the total, I'm going to say costs, not just wages, but total costs that are eligible for credit. So the limitations on the per day amount are at the wage level, and you then add your daily or appropriate cost of healthcare and Medicare. So the total credit's 38,308.68. And I haven't looked at a 941 form and I can't tell you how many years, but I did it and Elizabeth checked me and she of course found a mistake. So thank you, Elizabeth. But this form that you're looking at right now, can you see the numbers, guys? Can we see them? Okay, good. I said, let's assume there were 40 employees on the payroll for the quarter with a total of 468,000 of wages paid, 95,000 of federal withholding tax. And over here, you basically, the way the form is filled out, you basically carve up your $468,000 of wages by subtracting your sick leave wages and your family leave wages. So you have the three components there. And then on this right side over here, this is your total Medicare and Social Security taxes before, and then your total that would be due for the quarter, including your $95,000 up here of federal withholding taxes. And then we get to the carve up of the credit between the non-refundable portion and the refundable portion. So just to finish up with the form, and then I'm going to show you where these numbers come from. The non-refundable portion of the credit is $27,324, and the refundable portion of the credit is $10,984. So even if you didn't have enough employer expense in the quarter, you will still be able to get your full credit because it's a refundable credit. So let's see if I have my worksheet. Oh, I have it open here. Bear with me. It's already open. Here we go. Okay, so the total Social Security tax that we saw on Form 941 was $54,000, and basically the employer's share is 1/2 of that. So the maximum amount of non-refundable credit is the $27,000, and it's really as simple as that. You just take the $27,000 and subtract that from the $38,000 to get to the refundable portion of the credit. These are just intervening calculations that if you're doing this and if you don't have even if you do have a payroll company that's doing your payroll, I think that it's important for everybody to understand here, and when Elizabeth talks about the employee retention tax credit, you need to be providing the appropriate information to your payroll tax provider, including the different employer share of Social Security tax, employer share of Medicare tax, healthcare costs, and of course, the wage numbers. So hopefully running through an example was helpful. And let's see if I got this here. We went through the worksheets, and I'm going to kick it over to Elizabeth to talk about the changes under ARPA to the employee retention tax credit.
Thank you very much, Sherry. I'm going to give an overview of this very interesting credit that has evolved and morphed under the 3 acts that have taken place in the past 13 months. The original CARES Act, when it came out, spoke only to March 12th of 2020 through December 31st, 2020. And at that time, the businesses, the eligibility for a business would be, did you have a complete or partial shutdown suspension as a result of government mandates, or did you have a significant decline in your gross receipts? And at that point, the comparison was, for example, a calendar quarter compared to the 2019 calendar quarter. Did your gross receipts decline by at least 50%? At that time, under the CARES Act, if you had a PPP loan, you were not eligible to get the employee retention tax credits. And there were limitations on employers who have more than 100 employees. Then when the CAA, or the December Act, as I like to call it, came about, the significant decline was gross receipts reduced by 20% compared to the same quarter. So if you were looking at third quarter 20, you were looking at the quarter compared to the same quarter in 2019, you were looking at a 20% versus the 50%. And this applies to the first and second quarter of 2021. So you're looking at the quarter that just passed versus the same quarter in 2019. And this went to the eligibility now for PPP borrowers. They were now able to take the employer retention credit, but we must be very careful to not double dip and take into consideration for the credit wages that are also being used for PPP forgiveness. The limit on the wages, qualified wages for employees, went from 100 employees. Now, if you have more than 500, the limitations come into place. And when you're looking at the quarters, because I know I had this question, is you're looking at calendar quarter to calendar quarter. Fiscal year taxpayers need to remember that it is a calendar versus a calendar, not your, for example, third quarter in your fiscal year versus your third quarter in 2019 is the calendar quarter. The American Rescue Plan Act, or the March Act, as I like to refer it to, added provisions for recovery startup businesses, for businesses that were not in place at February 15th of 20. And they added a category of severely financially distressed businesses. And now we have the credit available for the third and fourth quarter of 2021. Again, the PPP borrowers are eligible for the credit. So if you have first PPP loan or your second PPP loan, still eligible, but again, the double dipping of making sure you're not taking the wages used for your PPP forgiveness or covered under these PPP proceeds for the employer retention credit, and the 500 employee or above limitation is still in place. There's also an optional method in calculating your gross receipts where you can compare for your to take the credit for the first quarter 2021, you can compare your fourth quarter 2020 to your fourth quarter 2019. For the second quarter of 2021, you can compare your first quarter 2021 to first quarter 2019. And so these are just optional methods for your gross receipts decline if you're not using the first quarter, 2019 versus 2021. Next slide, please. So the CARES Act allowed up to 50% of qualified wages, up to $5,000 for each full-time equivalent, with a $10,000 annual wage limit. And again, you had March through December 2020. The December Act now changed it to 70% of qualified wages, up to 14 for each full-time equivalent, with a 10,000 quarterly wage limit. And again, the consolidated appropriations, the December Act covers the first 2 quarters of 21. And then the March Act still has the 70% of qualified wages, 14,000 per each full-time equivalent, with the 10,000 quarterly wage limit. And this applies to the third and fourth quarters of 2021. Now, your qualified wages includes healthcare expenses, and there is criteria as to what's considered the healthcare expenses. And I'm not going to go into detail on that, but there is certain criteria, and there's the guidance on how to calculate full-time equivalents, et cetera. And then There's also unqualified wages. There is a small provision regarding if you're a C corporation or a subchapter S, rules about more than 50% owners and their relatives and having to possibly back out those wages in the employee retention tax credit calculation. The CARES Act did not tell you how to calculate gross receipts for tax exempt entities. The December Act then put into place the criteria for calculating the gross receipts for a nonprofit or tax exempt entity. It clarified a little bit for-profit, I'll call them entities. And the March Act did not change the definitions of gross receipts, but it did add gross receipts definitions for the recovery startup businesses. So gross receipts, as you can see on the Consolidated Appropriation Act column for tax exempt contributions, gifts, grants, etc. And that's all detailed. For a for-profit, you're looking at sales net of returns. You're looking at any income from services provided and investment income. What you see there for the tax exempt as far as sale of assets and investment income, dividends, rent, also applies to a for-profit entity. Next slide, please. So this employer retention credit is also claimed on the 941. And Sherry showed you what the 941 looks like for claiming the sick and family leave. And then there was that worksheet, Excel that she showed you. That was areas were filled in again for the family and sick paid leave example. So it's broken up into sections of step 1, 2, and 3. So here's the 941. So there were extra lines for taking into consideration the line 11C, non-refundable portion of employee retention credit. As you see there, the 11C for that comes from the worksheet. You have on page 2, you have the refundable portion, again, from the worksheet 1. So we have additional lines that one would fill out if you had both items, sick, family, and the employer retention credit. And then the worksheet has a separate section that deals with calculating the employer retention credit. And that is the third section of the worksheet. So step 1 and step 2 were filled out for Sherry's example. And step 3 here, again, is you're picking up the information from your 941 and making the applicable calculations that then go to the form 941. So you would have it as a credit against your 941. You can also receive an advance credit, 7,200. There's also a form for self-employed. Sherry touched on the fact that self-employed can still have those sick leave, but there's also an employee retention credit for self-employed. One change that the March Act did is that we now only have the credit against the employer's share of Medicare beginning with that second quarter, July 1st of 2021. And the examples that Sherry had shown and the worksheets and the 941 that are shown are specific only for the first quarter 2021. Yes. And the IRS is going to make some changes to the forming calculations at the appropriate time when these returns are due later in the year. There's a lot of FAQs, and I have to say that the IRS website is behind in some of their guidance, and this has been an ever-changing employer retention tax credit, and it is very much a fact-based to determine your eligibility. Do you have the full or partial shutdown? The gross receipts issues, that's pretty clear cut how to handle that. And it is an or. Did you have a full or partial or gross receipts decline? but that's where the bulk of the questions, at least in my handling of any questions that come through the COVID-19 on the employer retention tax credit, is the am I eligible? And again, very much a fact and circumstance that we really can't cover all of the criteria in this particular session. And then the statute of limitations, again, under the March Act, has been expanded under that particular act. So next slide. It's just really a understand the eligibility criteria. And again, it's very fact-based. Talk with your payroll tax provider. They have a lot of great resources. We work with, Paychex, ADP, and some of the other providers, and they've been very helpful to clients. One of the things that I always stress in talking to the clients is to make sure that your payroll provider, you ask them, how do you classify your wages? They have to know, do you have qualified wages or not? They just can't assume. So you need to speak with them as far as what you have to select from drop-down menus and what information you need to provide them so that they can prepare the 941 correctly. And obviously you can consult with us as needed for trying to get through some of this eligibility determination and criteria.
I think, well, Elizabeth, if I can jump in for just a
Yeah.
second. One of the things that we've really seen is, I think, like, for example, Paychex has done a fabulous job with developing reports for the PPP, for the employee retention tax credit, FFCRA. But the one thing that we found with our clients is that they didn't necessarily provide their payroll providers the appropriate information from the get-go, so to speak. So it's been, maybe our clients haven't, you can't just use the information that comes right out of Paychex or ADP or whatever at face value. You really have to take a look at what it is that's being provided, by them, and make sure that it makes sense. And they also don't address related, like, owners. So you said for the ERTC, an owner, you can't use their wages or the family wages. Well, Paychex and ADP aren't going to know who's a family member. They cover if somebody's over $100,000 for the PPP loan, and we'll get into that later. But they don't necessarily know, again, who's an owner, so that you can capture that information. So it's really just be aware that it's GIGO, right? Garbage in, garbage out. If you don't get the right information, you're not going to have the right information to prepare the forms.
Yes, that's correct. Thank you, Sherry. Yes, and also I want the audience to remember that even though 2020 has now passed, if you now take a look and reassess, you can amend your 941s for 2020. If you go through and you meet the eligibility requirements, you can amend. So it's not all lost to go back and take a look at 2020. So now we're going to go through, and this is really more for walking through and understanding the thought process. So I mentioned this double dipping, and the PPP loan proceeds, that whole program was to keep employees working. And the government has said, well, if you've got that, you can't also get an employer retention tax credit. If you have other funding, COVID-19 relief funding or other funding that covers your payroll costs, you can't get the employer retention credit as well. So what we put together is really a layout here, and it's in the form of more of what I call the tax exempt charities. But again, it's the thought process that we'll discuss that pertains to a for-profit and nonprofit. So in this particular schedule, the costs for all payroll has been laid out amongst the different programs. For a profit corporation, you might have certain divisions, or you might have certain business areas that are all different, the supermarkets and grocery stores, and some of the restaurants with delivery, in-person dining, outdoor dining. So again, the thought process applies the same way. You take a hard look at where you have your payroll costs. And you can see here, we got payroll costs and what the combined are. And then there's some other costs for rent, occupancy, personal protective equipment, which is now a medical deduction on your individual return or business return, supplies, phone. And so here's your total expenses. And in this particular instance, because it reflects more of a nonprofit, we've got an allocation of general and administrative payrolls and other costs to these other programs or divisions. So now we have all our costs laid out. Now our revenue sources. In this particular case, there is, each program has got a revenue source. There's subsidies in the day program. There was a hazard pay program that provided funds for this particular employer to give hazard pay. We've got Medicare funds. There was a rate increase. There was HRSA monies that came in the day program, the residential program. The school program, they're covered by a Department of Education tuition reimbursement. And then we have other program in general and administrative. Again, you're laying out all of your revenue sources, your gross receipts, as they apply to each area, each division, each program. Now we have to take a look at those payroll costs and say, so what am I using for or used for payroll forgiveness under the Paycheck Protection Program? What did I use? So I've got to pull those costs out. For PPP loans, you have the wages, employer portion of state taxes. You also have health insurance, dental insurance, a whole bunch of eligible expenses. And you also have covered utilities, rent, etc. So this bottom part is showing the different revenue streams that are covering payroll expenses that are now, being pulled out and giving us a net of PPP eligible payroll costs, what we have left. And now we have to pull out the PPP and other expenses that are ineligible for the employer retention credit, like employer payments to a pension plan. You have certain other costs within there. Now we are left with the pure, what you can use as qualified wages for the employer retention credit. So in this particular day program, 261,000 in payroll costs are still available. Under this residential, we have nearly 1.3. The school has nothing, because again, everything was covered under their Department of Education revenues. And the other program has 186,888. So now you've pulled out the relevant information to avoid the double dipping situation. And you have to look at it with, again, having to possibly prorate during the quarter, the health insurance costs that you have for the eligible qualified wages away from the ones that are used for the PPP loan forgiveness or potential forgiveness, because right now we're in PPP loan number 2, and some people are just started to get their proceeds in the first quarter of 2021 or the second quarter that just started in April of 2021. Then we'll also put together a little discussion for partial shutdown. And
before we go there, Elizabeth, I wanted to just add what really makes this complicated and convoluted when we get down to what's available for the ERTC, so you don't double dip, is you really need this information on an employee by employee basis. Because remember, a lot of this is the first $10,000 of wages, or the first, and then the interplay with the FFCRA. So you really almost have to do this analysis on an employee by employee basis and make sure that you can support your remaining wages here with the employees, so you can prove that you're taking into account their first $7,000, you know, 5,000 if we're going backwards, 10,000.
Yeah.
And then this year it's up to $28,000 for the ERTC. So this is really oversimplified, and I just want to make
that is true. Yeah, there is a lot of factors. I know I've asked clients a lot of questions about, are you taking into consideration the PPP loans? Are you taking into consideration all of the COVID-19 funding? There's a lot between federal, state, and local levels.
Yeah.
Yes. Are you taking into consideration the fact that you are using some of these wages? You have sick and family leave, and they all have to be pulled out.
Right. Okay.
It's a thought process. You have to really think about where your payroll costs are, what you've paid in this particular quarter, and what monies you have received that touches payroll costs, like the hazard pay. You were given extra money to be able to pay employees an extra for hazard pay. So
right.
You pull that out. So it is a very serious fact, line by line calculation, as Sherry said.
Right. And it also, I mean, in this case, so, you know, we've spent a lot of time with human service agencies. So the hazard pay we know was directly to cover the hazard pay costs. So that's simple to follow that through, assuming it was all wages. But then they were given an increase to their Medicaid rates. And so we're taking the position that that rate increase was to cover wages, because that's what we believe the intent of the rate increase was, because day providers their employees were now going over to the residential group homes and whatnot to cover the positions that were necessary. So the position that we took in this particular scenario is that this whole $800,000 rate increase goes directly against wages and wage related costs. So everybody's situation is going to be different, and you really just have to be thoughtful about the different revenue sources and then your unique situation of how they get applied. Okay, and then here's your partial shutdown.
Yes, so that's also been a question, because again, employee retention credit, did you have a full shutdown under a government mandate? Did you have a partial shutdown, or did you have a decline in gross receipts? And again, this is the thought process using the same, programs here that we had previously, is where are we, what are we looking at in each of the particular divisions, or in this case, programs? So we have revenue sources across all programs, and you'll see here the percent, which is the day program is 11% of the total combined. The residential program is 46, the school is 28, the other program is 3. And there is a concept in the guidance of if you're an essential business, this whole fact here, if you're an essential business, could you have had a partial shutdown or not? And they give guidance on, is the particular area or program more than just nominal? And the guidance has if the gross receipts are more than 10% of your total, and the gross receipts of the particular program, more than 10% of the total, then it's not just a nominal part of your overall business or your overall mission. So you're looking at 2019, and in this case, the other program is less than 10%. So it is nominal, but the other 3 programs are over 10%. And so that's more than nominal. That could possibly, again, with all the other eligibility criteria, may make it that you've had an essential business with a partial shutdown. There's also, and again, it's an or, you can take a look at the hours of service. And so we have the full-time equivalents, how many hours, and the hours by program. And you can see that what we have a 25%, 51, 24%. And again, it's the same 10%. So 25% of the total hours of this particular program out of all the hours for this program. And once again, you know, the program, the other program is less than 10%. So the other three programs are more than just a nominal part of this entity's programs and or in a for-profit business. And I just wanted to kind of touch on some of the questions when it comes to the partial shutdown. One of the questions I had was, so I don't have customers anymore who wanted my product. What am I going to do? I'm open, I'm essential, but I don't have people that are obtaining our services or buying the product. And the guidance has said, well, sorry, no, just because you don't have the customers you used to have doesn't mean that you've suffered a full or partial shutdown, because that actually would be reflected in your gross receipts decline. So if you don't have the customers, therefore your gross receipts should go down. And there's other partial shutdown criteria, not just, you know, the nominal, also for the essentials, is if you cannot get your suppliers. And if you're shut down, being able to get supplies or a particular part, then you may have a partial shutdown. So it's a big laundry list of various bullet points within the criteria as to what is considered a partial shutdown. The full shutdown is pretty easy, because if it's a government mandate that said that's it, that we had in 2020, you are not essential, you're shut down, that's easy. It's this whole partial that is a very gray area in the eligibility requirements for the employer retention credits. So that's the overview on the credits. There's a couple of things that we'll quickly, again, go over here, is that we have extensions to unemployment insurance. So the number of weeks have increased. The time frame for receiving benefits has gone out. We now have the $300 per week supplement that stopped in 2020, now going out to March of 21 under the December Act. Next slide. The March Act now brought the unemployment assistance out to September 6th, and the $300 per week now goes out from to September 6th. And one of the late provisions is that the $10,200 of unemployment benefits that you receive in 2020 is not taxable for federal income tax purposes. And the IRS has said, if you filed your tax return before this, March Act was in place, do not amend your tax return. They will do the calculations and they will send you any refund and make any of the adjustments. So the IRS is behind anyhow. They wouldn't be able to get to your amended returns to begin with. So you just have to wait for the government to do that calculation for you if you filed your personal tax return prior to the March enactment date. Couple of other that we'll just mention briefly is there were individual provisions to the earned income credit, which is basically for year 2021. It expands the percentages and the amounts. There's a child tax credit that increased from prior years. It's now up to $3,000 for a qualified child under the over the age of 6, and $3,600 for any qualified child under 6 years old. And a new wrinkle is that the IRS is supposed to be sending monthly advance payments on the new child tax credit amounts. How they're going to do that, I don't know. My understanding is going to be some sort of a questionnaire or something because they need to start making payments July 1st through December 31st of this year. So the child tax credit is also fully refundable for low income taxpayers. There's also a student loan discharge of debt that was expanded by the ARPA. So if there is student loans for post-secondary education, and this affects student loans that are discharged in 2021 through December 31st, 2025. So we have several years. It's not included in income, the student loan discharge of debt. But there's certain types of loans and certain criteria for this discharge. But there's no information yet on how this is going to be reported on the tax returns. But again, it's for the 2021 forward tax return. So they should see some guidance coming out, hopefully later on in the year before the 2022 filing season. And next, just a couple of FYIs. The filing deadline, May 15th. They confused us all by keeping the estimates for individuals at April 15th. Gift tax returns were not extended. They were still due April 15th. The FBAR foreign reporting was also due April 15th, but again, deadline was missed. No problem in this case, it was auto extended. And if you didn't receive your recovery rebates, the 1,200 in April, the 600 near the end of the year, the 2020 tax return is where this is calculated to determine that you are receiving the amount that you're entitled to, because the rebates were based upon 2018 and 2019 tax returns. And now we have a third one that has come out in 2021 that I believe is 1,400. One of the biggest uproars had been with the PPP loan proceeds. The taxing authorities had said that you could not take as a deduction the expenses used for your forgiveness. That's been changed with the acts. Some of the states, most of them are coming on board with that, but we still have to check the state rules as far as inclusion of the deduction of these PPP covered eligible costs being taken as a deduction. There's also COBRA premium subsidies. And if you are eligible, an assistance eligible individual, and just briefly, the criteria is if you're eligible for COBRA due to a qualifying event and you elect COBRA continuation coverage, then you could get a subsidy towards your COBRA premiums. The individual would not be paying the premium, but depending on how the plan is for the COBRA insurance, either the employer or the plan administrator or the health insurance company would get the payment directly. So someone who qualifies and elects this will not pay the COBRA premium. And again, the money is going to come directly to whoever is got the insurance coverage. And group health plans must provide notifications. So you have to have notifications to the assistance eligible individuals. And so I suggest strongly that everyone takes a look at their health plan documentation and make sure that they have the health insurance has sent out the appropriate notifications, because the clock starts on being able to say, I apply for this subsidy, I'm eligible for this subsidy. I believe there's a 60-day once the receipt of the notifications. So this is very important for business owners to take a look at. And as you can see here on the slide, the employee gets the subsidy, and there's a tax credit that the employer gets based on the subsidy amount against their Medicare payroll tax. And then the employer provided dependent care, the cafeteria plan, as we call it. It used to be capped at $5,000 for dependent care costs. Now it's up to $10,000, and for married filing separate, it's up to $52,000 50. So again, cafeteria plan documents should be amended or have addendums to reflect some of these changes that have taken place as it results to employee benefits. And now, in order to get, I guess, the restaurant industry really, ramping up again, businesses can take 100% of their meals, food, beverages expenses versus the 50% that was in place for 2021 through December 31st, 22. So the criteria is you must have that the business owner or an employee of the business is present when the food and beverages are provided. So if you're going into a restaurant and having indoor or outdoor dining, that's one, again, criteria. And you can't have grocery stores and convenience stores that have prepackaged. So if you have Wawa catering, you go out and order Wawa for your business lunch, that doesn't qualify. But if you have the local restaurant that's going to cater your business lunch in your office or other site, then that would be eligible. So again, this is just a temporary provision, again, to, I guess, ramp up some of the hard hit restaurant industries. So I believe that's the end of my session. Went a little bit beyond time, and Kyle, I believe, is the targeted economic injury disaster loan advances.
Great. Thanks, Elizabeth. And we are running a little behind. I've been managing the Q&A. So Elizabeth, if you could just take over with the Q&A. I'm hoping we don't have a lot of questions at the end and we can manage them all throughout the presentation, but I'm going to try to speed through some of my session just to make sure we have enough time.
Okay.
Well, and Kyle, if I can just say, I think it's probably good to just make sure we focus enough on the PPP, and we can always run through, or just everybody, the slide deck will be available for the restaurant revitalization and the shuttered venue. So if we don't get to that in any great detail, I think people still want to hear about PPP.
Okay. So the targeted EIDL advances. So as most of you are aware, there was an economic injury disaster loan advance that was available at the onset of the pandemic. And the advance was in the form of a grant up to $10,000 and was calculated at $1,000 per employee. The SBA has now extended these grants from the CARES Act, and they're only available to those who have previously applied for an EIDL advance. And if you haven't received the full $10,000 advance, you most likely were contacted by the SBA through an email asking if you're interested in applying for the targeted EIDL advance. There are three different criterion for which you have to meet in order to qualify for a grant. And just high level, you have to be located in what's a designated low-income community. And the SBA will actually map your business address to confirm this before they even go forward with the application. The second eligibility criteria is that you would have had to have suffered an economic loss greater than 30% in an 8-week period beginning March 2nd, 2020 or later compared to the previous year. And again, they're going to ask for detailed monthly gross receipts information from January of 2019 through the current month to date period. And then the last criteria is that you have fewer than 300 employees, and there are certain exceptions and exclusions there. The EIDL advance, again, as I said, the total amount would not exceed $10,000, including your initial advance. And you would, in order to qualify, you would actually have to sign a 4506T, allowing the SBA to access your tax records to confirm some of your gross receipts, or at least check them against your application. And the SBA's goal is for a 21-day turnaround time on reviewing applications and making determinations. The amount of the advance or the grant is not included in gross income, and it's treated as tax exempt income for partnerships or S corporations. All right, so the Paycheck Protection Program changes and updates. So as we said before, the American Rescue Plan Act added an additional $7.25 billion in PPP funding. It extended the application period of the PPP loan applications through March 31st, 2021, which was further extended by the PPP Extension Act of 2021. And now you have through May 31st of 2021 to apply for a loan. So in terms of qualifications, the matrix on the next few slides lay out the different criteria based on the different acts as we have laid out previously. So under the American Rescue Plan Act, the qualifications, they added certain internet-only news publishers. We don't work with any of them that I'm aware of. So this was a unique and distinct group that they added. Also added all other 501c3 organizations with the exception of C4s. So this includes labor organizations, social recreational clubs, religious groups, fraternal benefit societies as well. And in terms of the maximum loan amount, there were no changes. So under the first draw, you could still get up to $10 million. And under the second draw, you could get up to $2 million. And the loan calculation, there were no changes from the CARES Act or from the Consolidated Appropriations Act. And I just wanted to note that the Consolidated Appropriations Act did clarify that your computation for the loan amount must be based on a calendar year and not a trailing 12-month period. Next slide. Payroll costs. So as defined by the original CARES Act and the Appropriations Act, there was one modification or change that was made. Under the new act, you cannot use COBRA premium subsidy payments as payroll costs, since there is a reimbursement that's available via payroll tax credit, again, as Elizabeth covered before, against your Medicare tax payment, the employer portion of your Medicare tax payments. Eligibility. So this is a unique one. So there's a lot of, if you were to read through each of the IFRs for each of the acts and about eligibility criteria for exempt organizations, under the American Rescue Plan Act, the one thing that they did clarify is that for 501c3 organizations, if they employ no more than 500 employees per physical location, then they would be eligible for a PPP loan. And we do have some clients that fall under this criteria for eligibility purposes. And they've also indicated that for C6 and other 501c organizations exempt under Section 501A, they can't have more than 300 employees per location. And then there's also there was a unique industry specific clarification that was made under the American Rescue Plan Act about lobbying activity. They have carved out specific limitations on lobbying activity of exempt organizations, 501c organizations. So there's certain industry specific issues around parameters for lobbying activity. So in terms of eligible expenses for forgiveness, with the exception of the changes about the COBRA premiums, eligible expenses for forgiveness are those that were originally laid out in the CARES Act as well as the Consolidated Appropriations Act. And I just wanted to point out that remember that the Consolidated Appropriations Act did add 4 new cost categories, which are laid out on the slide there: cover to operation expenses, any property damage that was suffered, necessary supplier costs, and worker protection expenses, PPE. As far as
this one, Kyle, is covered in a lot of different relief provisions. So this is one of those areas that you'd have to be careful you're specifically tracing to a funding source.
right. And in terms of the covered period, so once you receive your loan, how long that loan is supposed to cover your expenses for. So under the CARES Act, it was either 8 or 24 weeks. Under the Consolidated Appropriations Act, they came out and said that it could be any period between 8 and 24 weeks. And the same is true under the American Rescue Plan Act. So there were no changes under the current act. Next slide. As far as forgiveness application, so there were no changes. There are still 3 forms for application for forgiveness. And the Consolidated Appropriations Act did have, I guess, what I'll consider a somewhat substantial change, because most banks actually pulled down their portals for forgiveness applications because of the changes as a result of the Consolidated Appropriations Act. Number one, it added those additional cost categories, but it also no longer requires documentation for eligible expenses. And you would, the SBA changed the form itself for the form 3508S. And now it would be for applicants whose loans are under $150,000. And you would identify on the face of the form itself what your payroll costs were, and you're no longer required to support to upload supporting you're no longer required to provide supporting documentation, although banks are mainly asking for it regardless. In terms of the EIDL advance interplay, at the onset with the CARES Act, there was a lot of confusion as to how this played in with the PPP forgiveness. And initially the SBA, when they were processing the forgiveness applications, they were deducting from the forgiveness amount any advances under the EIDL. And the Consolidated Appropriations Act clarified that within the forgiveness application process itself, the EIDL does not come into play and does not factor into the amount of the amount of forgiveness on your loan. So if an example would be, if you received a $150,000 PPP loan and you qualified for a $10,000 advance, if you would have submitted your application very early on in the process, you may have only received notification that your forgiveness was $140,000, the maximum loan amount of $150,000 less the advance you received. But what happened as a result of the Consolidated Appropriations Act is they clarified that the EIDL advance does not need to be backed out for forgiveness purposes. Okay, so as I said, you can apply now through May 31st. If you did not take a first draw loan, you must do so before applying for a second draw loan. And the lender submission process to the SBA has changed a bit, but you wouldn't see any of that. That's really on the back end at the banks themselves. And just to kind of highlight on what our experience has been. So most banks had opened their portals, and most of them are still open to accept the forgiveness applications. As I indicated, when the Consolidated Appropriations Act had come out, some banks had temporarily pulled down their portals or restricted access to their portals to make the necessary changes. And most, if not all, banks now have their portals up and running and are ready to accept applications. And again, just wanted to clarify, the simplified loans under $150,000. So the process on various lender portals is quite simple, but don't forget to keep all of your backup to prove your forgiveness, and not only prove your forgiveness, but I would say keep all your documentation to support the original loan amount you applied for, as well as to demonstrate the necessity for the loan, which is somewhat important.
On that point, our experience has been if we scroll back up here for a moment, a lot of our, again, our not-for-profits, when they added this category of 501c3 organizations where there's no more than 500 employees per physical location, a lot of our human service agencies, that this is the case, at least at, and I'm going to say an affiliate level. So it was a matter of, well, can they now apply? But you still have to go back to your point, Kyle, you still have to be able to justify taking the loan and the need and your lack of ability to get funding from other sources, regardless of, you know, these new relaxed opportunities or eligibility criteria. So we can't really forget that that's the original purpose of this PPP program. So we've spent a lot of time talking to clients about this particular issue.
Okay, so the restaurant revitalization grants, so these were approved under the American Rescue Plan Act. There is $28.6 billion in grants that are available, and they're broken down into a couple different groups. So $5 billion is available for businesses whose gross receipts are less than $500,000, and that's based on 2019 gross receipts. There's another $4 billion that's set aside for restaurants and other like establishments whose gross receipts are between $500,000 and $1.5 million. There is $500 million available for organizations whose gross receipts are less than $50,000. And then the remaining pool of funds it's said to be distributed equitably based on the gross receipts of those that apply. However, it remains to be seen how those monies will be divvied up. Applications you can submit your application starting at noon on May 3rd via the SBA's website. And I just looked today, and actually the SBA has a webinar, or a bar or a similar establishment. They have a webinar today at 2:30, but I think it's limited to the first, couple hundred people who apply or who register. Next slide. So these amounts will not be included in gross income. And again, they'll be treated as tax exempt income for partnerships and S corporations. And the eligible entities include restaurants, caterers, inns, taverns, tasting rooms, bars, lounges, food trucks, carts or stands, breweries, wineries, and priority will be given to those businesses controlled by women, vets, socially and economically disadvantaged individuals. And the SBA said that for the first 21 days, they're going to give specific. In terms of ineligible businesses, so these would include state, local government operated businesses, any chains of more than 20 or more locations, those connected to arts entities, since they may have, if they have shuttered venue operations grants, and then any publicly traded companies. And so just for a description of the grant, so the way I look at it is it's a lost revenue gap grant. So the computation, and you can download the form on the SBA's website if you're interested in applying or will apply. I recommend that you look at the application. So you would take your 2020 gross receipts, you would add to it any PPP draws that you received, and then you would compare that with your 2019 gross receipts. And then the difference between the two is essentially what you're eligible for in terms of a grant. And again, the SBA is going to ask you to submit form 4506T for the SBA to verify your gross receipts. Let me make sure I answer this question right about my favorite sports team, because I don't want to.
It's Yankees. Kyle, Yankees.
Yeah.
Yeah. Mercadien rivalry.
In terms of certain caps on the grants, so there's a cap of $10 million per business and no more than $5 million per location. And there's actually a minimum of $1,000. So I I think if you're under the $1,000 gap, then I don't even think you would qualify for anything. And then in terms of the eligible expenses, so eligible expenses would be any that any expenses incurred during the period of February 15th of 2020 all the way through December 31st of 2021. And then in terms of expenses, these are all your eligible expenses. You know, the one on here that the construction of any outdoor seating.
Yeah.
And then, you know, careful with double dipping. So some of these costs would be eligible under the Paycheck Protection Program, such as
PE.
cost, mortgage, principal, rent, utilities, the outdoor seating construction, PPE, some of the covered supplier costs as well are eligible under the PPP. So
Right.
make sure that you're not double dipping. This continues to be an issue with the various assistance and grant programs that have been available. And that's it.
So question, what kind of Q&A do we have? Because I will just skip through this. I think let's just skip through this to say that there is a shuttered venue operations grant for theaters, live venue operators, performing arts organizations, you know, similar to restaurants. We all know that Broadway's been shut down and, you know, the arts are suffering. So very quickly, their requirements, you know, similar to the PPP, had to be in business as of February 29th. And if you are a venue, initially, you couldn't have both a PPP loan and the SVOG. However, they've now modified this to say that if you received a PPP loan on or after December 27th, you'll have the SVOG reduced by the PPP loan amount. There's a prioritization. So we've actually been working with some of our theater clients to make sure that they can be up in this first or second tier priority. So they're opening the portal up for entities that suffered a 90% or greater loss first for the first 2 weeks. Then entities that suffered a 70% or greater loss of revenue are eligible to apply. And then there's a third priority. So it's being prioritized, you know, based on revenue loss. And similar to all the other other relief programs, I would say that there's really nothing. The one thing here, state and local taxes and fees stands out to me as being a little different from some of the other programs. Insurance payments, but you know, that can fall under operating expenses. So, and again, no double dipping. So what do we have in the chat?
Well, I just want to re-emphasize, because I saw some questions and I had gotten questions previously. When you're looking at the quarters, you're looking at calendar quarters for the employer retention credit. You know, payroll is based on a calendar quarter. So fiscal year filers, for example, if you have a June 30th year end, your fourth quarter is April to June of 2020. But you have to look at fourth quarter is actually October 1st through December 31st, 2020. So I just want to make sure that fiscal filers out there understand, and again, it's easy, sort of easy, I guess, in my mind to remember, is that your payroll quarters are calendar quarters. So you're looking at your gross receipts based on calendar quarter comparisons. That's key, as well as looking at when you had your partial shutdown or full shutdown, you're looking at the calendar quarter. So I just wanted to emphasize that, because that seems to be a question that has come up several times as it relates to fiscal year-end taxpayers.
It's also for the PPP loan. If they've now clarified that it's on a calendar year basis as opposed to anything other than that. And I honestly think that part of this is to help ease the verification of the information that's being submitted, because, you know, most people are reporting either on a calendar year or, you know, a calendar quarter basis. So it's easy for the SBA and the banks and the different, you know, even the local authorities to be able to tie out the information that you're submitting in your application to underlying information that you've already submitted to another tax authority.
So Sherry, there's a question that came through the chat. If you have a museum but no area for seating, does that make you ineligible for the shuttered venue grant?
No area for, I don't have, off the top of my head, I don't have the answer to that question, but if they email us, I will walk through that with them after the seminar.
And then there was another question that came in earlier that I couldn't answer. Can employers elect to extend the emergency sick leave provisions without also extending the family leave under the American Rescue Plan Act?
I guess off the other, because it's a voluntary for 2020. It was mandated that you must do so.
Right.
But it's an interesting question in that, again, this is one purely voluntary by the employer to offer the paid sick or the paid family if the person makes the criteria, instead of the employee using their own paid time off or we're not getting paid. I honestly don't know. I haven't seen that addressed, if you can do one or not the other. Your gut says, well, because it's voluntary, maybe you can pick and choose. When it was,
That's what my gut tells me.
Couldn't
My
do
gut
that.
tells me that if you want to opt to give your paid sick leave, just make sure that you're calculating your maximum wages appropriately, and you know, it's optional. So as long as you're under the parameters of the program, you're still eligible for the credit.
and I guess document. When you are calculating your eligibility for the employer retention credits and any of the other like grants and such, and again, the family leave and sick, that you have it documented and you're not even favoring one employee over another, is how I'm going to say it, that it is applicable to everyone. It's really important to have documentation.
So there are no other questions in the chat or in the queue, but I guess, you know, based on some of the questions that we've received, I guess I'll just throw out a general question. You know, there's a lot of information and a lot to digest and dissect and figure out how it specifically relates to individual organizations or companies. Where can people go for additional resources besides, you know, whether it's Googling, you know, can you talk about what information that we have available on our site, or how to find more information, or how to get in contact with us?
Yeah, so our website, you know, www.mercadien.com, we have we have published newsletters and we have published guidance out there. You know, I don't even know if I could bring it up, but we have a lot of information out there, and there's actually an email solutions that you can, if you need information about COVID relief, you can send us an email, and it's just out there today, actually. So we have, let's see if I can find it.
If you go to the top, Sherry,
Did it not load?
no, go higher. Knowledge and insights, just click that.
Oh, I didn't know if there was something here. Newsletters.
So if you scroll down, you can see all the articles, and
Right.
we also have our webinar replays up here as well.
And there's a bunch. We actually got questions about unemployment insurance fraud, because that was going on last year because of all the unemployment claims. So there were questions submitted about, is anybody else experiencing that? So I looked out here earlier today to see where our newsletter article was for what to do if your employees start to receive letters saying that they've put in claims for unemployment, but they really didn't put in claims. Ashley, where's our, if the questions, the contact for,
If you go to contact, or are you looking for the COVID one?
yep, the COVID.
Go hit Mercadien so you get back home. The logo. Yeah. And then on this first screen, it's going to say contact us on that banner with the trees. You have to go back.
What?
So,
You would think I would know how to navigate our website. I'm just really
Yeah.
not doing a really good job of this.
I'm going to request control. Can you let me have control?
So
You take
Elizabeth,
some marketing person to.
Elizabeth, we had a question come in. In 2020, the employee had to write a letter to request the sick pay leave. Is that the same for 2021?
So when you go back to documentation, again, there was certain criteria because the 2020 mandatory. Now that this is voluntary, you need to document. If you're going to offer, again, because this is voluntary, if you're going to offer the paid sick leave or the family leave, you should have the documentation from the person who is eligible for this, if you're going to give it, reason why. So that number one, again, it's documentation, but you also have the correct leave for that person. Or are they requesting leave because they've tested positive, they have to care for themselves? Are they caring for a family member? So you want to make sure you have that documentation in place, be it a letter from the employee or a questionnaire being filled out that you may have standard to give to any employee, that you're going to be off, that again, as a policy from the business, that you're going to be offering this sick leave or family leave.
Okay, great. Barry, there's no more questions in the queue.
Okay, well, Ashley took us to the site, the section of our website under home, contact us for COVID-19 and loan assistance. So we actually get quite a few questions through this. It comes to us as solutions at Mercadien. So please feel free to reach out. And if they're, if you, and we're just helping to answer any kind of questions because it's just an overwhelming amount of information that's out there. So we don't have the answer, we'll go help you look for the answer. I guess that is my parting comment, because it's not all black and white. We've found that out
Oh, yeah.
clearly over the last 13 months. All right, so I want to thank everybody for joining us today. And again, don't forget to, if you've answered the polling questions, you should be eligible for CPE, and you should be getting that within, I guess, the next 2 weeks. So we appreciate your time. Feel free to reach out to us separately at our emails here. And if you have further questions and follow up, and have a great day. Thank you.